in Dallas about 7 months ago, and I really liked Shaker's story. I mean, I think to me this idea of somebody creating a business from scratch and being able to sell it was very inspiring. So thank you very much for sharing. And as you said, my background, I've been outside India for about 30 years right now. So I left India back in 1983 after I finished my chartered accountancy. Went to London for a couple of years, and then from London went to New York. Started my career with PricewaterhouseCoopers. At the time they were called Coopers & Lybrand before they got acquired by or merged with Pricewaterhouse. And then in London I was primarily doing controlling. I was a controller for a large company which is a lot of operations in East Africa. And one of those countries I used to visit often was Uganda. And so one day when I was in Uganda, I got held up at gunpoint. So then I decided this really may be a dangerous job. When I decided to do accounting, I never thought I'd get held up at gunpoint. So that's when I decided to go to New York and then joined a private equity firm. We are buying and selling companies. I was the president of a small New York Stock Exchange company, and we moved to Texas. As a result of that, I've started and sold 3 other companies, primarily technology companies. And before I joined ENCORE, I was the CFO of a publicly traded manufacturing company in Texas, NASDAQ listed company. So when a lot of the people, when you talk about ENCORE obviously goes with the French word, which means again and again. And if you leave with nothing else today from this presentation, I want you to leave with 3 different things. One is the experience of our team. We have in our senior management team, we have 900 years of experience. Number 2, financial discipline. We are truly, in the true sense of the word, we are Indians with, who take care of every penny that comes through the organization, because it's very, very important. What we do for our investors is very important to us. And number 3 is research. We do a lot of research. We use proprietary research models to decide how we're going to invest. Now, when we talk about all these 3 different combinations, I call them the 3 legs of the stool. We are the 3-legged stool, and the seat of the stool is seat of integrity. And what we have done over the years, we have been in business for 17 years, and we have never lost money on any single investment or any single investor's money. And that's really because the cultural value of our organization is driven by doing the best thing for the investor. In our particular organization, there's no worse conversation to be had than a president walking up to the meeting and saying, you know what, my numbers are not going to be what I projected. It's going to be a very, very long meeting. Our board meeting will not end that day, because until we know what the fix-it plan is going to be, the meeting will not end. And that is not a function of showing how the decision process works. It's really a reflection of how careful and how attentive we are to the needs of our investors. So we started our company 17 years ago. Dr. Sangani, our chairman, is originally from Bombay. I'm from Bombay too, although my family is originally from Karnataka in Mangalore. Shettys are all basically from Mangalore. My dad moved to Bombay soon after Indira Gandhi passed the Land Reform Act. We are a family of landowners, and he started restaurants. So I don't know how many of you know, but 90% of the restaurants in Bombay are owned by Shettys. It just turned out that they wanted to be in the restaurant business. So I grew up, when I was young, I used to go to the restaurant on weekends. That's how my dad trained me to think about money. And so Dr. Singhan is also from Bombay. And when he went to Cleveland Clinic after doing his residency, he wanted to decide where to locate his practice. So in the US, you have the opportunity of going anywhere in the country and saying, I'm going to start my practice there. But he had a different philosophy, which is also, again, very important, a cultural value of the organization, is when we think about medicine, and medicine has changed a lot over the years, right? It's no more about, 25, 30 years ago, you go to your doctor, he was really cared about you, He did not care about how many exams he can put you through or how much money he can make. And our chairman is no different. When he went to Gulfport, Mississippi, He wanted to do that because at that time in that particular place in South US, they did not have an interventional cardiologist. So if you had a heart disease in Gulfport, you're going to a different area of, which is 4 or 5 hours away from the city in order to get treated. If you are an Indian and you are trying to practice in the mid-1980s in deep South United States, you are very brave or stupid or both, because there's still a lot of discrimination. Again, you're Indian, you have a funny accent, and you're in the middle of where Martin Luther King started the civil rights movement. So he had a lot of guts. He went there and started his practice. It was an incredibly successful practice, but the philosophical focus was do the right thing for the patients, and then whatever money comes, we'll try to invest it elsewhere. Now, all of us invest in real estate, right? All of us. Our home is our real estate investment. But when we think about real estate as an investment, we tend to think very differently. You think, oh, I'll buy a house. I might, buy maybe a building or something like that, depending on what our economic background is. So back in the mid-1990s, in the US, we had the same culture about investing in real estate. So there is a Yale endowment fund. The money manager for the endowment fund came up with this theory, which has been copied very widely right now by all the pension funds in the US, not only in the US but internationally. He said that when you invest in real estate, most typically we invest in stocks and bonds, a little bit of metal, it could be gold for Indians, or any other thing. But we don't invest, when we invest in real estate, it's a contrarian play, because what happens is when stocks go down or stocks go up, real estate is the buffer, and when you blend it together, your portfolio does better as a result. Now this has been proven over and over and over again over the years. If you take what he said and extrapolate it back to the beginning of time, real estate has had the most robust returns of any particular portfolio that you can have. So Dr. Sanjani said, well, his wife Smitha decided to buy a couple of hotels. They did really well at it. And he said, wow, this is a good business to be in. Why don't we make a major business out of it? So it goes back to the first culture of building organizations around good people. So he partnered with Patrick Barber, who is a CEO. Pat is an architect by background. He's also has a finance degree. He had done a couple of $1 billion in deals before he came into partnership with Doc. So together they wrote a 10-year business plan, said we were going to create a perpetual real estate company. A perpetual real estate company. What that means is that we're not here for the short term. We're trying to build an organization that is going to be here for a very long time, in the future. So they created a business plan. The first focus was, this is the kind of a philosophical basis of how we're going to focus, which is I talked about the financial discipline, the detailed focus on all aspects of operation, and also invest at opportune times. Use research to invest at opportune times. And so this is a kind of a quick story about the dateline of what we did. So we started in '99 investing in a retail parcel in Mississippi, 150-acre parcel. This is a very classic development that you're seeing more of this in India. You start with a Walmart, a Lowe's, and then a Chili's restaurant, Outback Steakhouse, a movie theater, and they built out over 1 million square feet and harvested about $50 million in that retail center, and invested every penny of that back into a hotel portfolio. So they focused primarily on Marriott and Hilton properties. The Courtyard, the Residence Inn, the Hampton Inn, the Fairfield Inn, basically limited service properties which do not have a big food and beverage operation. And they attracted the attention of a lot of institutional players at that time. So one of the institutional players that came in, became partner of ENCORE at the time in '05, was Rothschild Group. I'm sure all of you have heard of Rothschild Group, one of the oldest investment firms on the planet. So they partnered with us in 2005, and we built the portfolio over. We got to about 40 properties in December of 2006. And in December of 2006, we had an opportunity of buying an $800 million portfolio of hotels. And when we did the research on this, the financial underwriting of it, we realized that it is really a wrong time to be buying, because we didn't see us making money by buying the property at a very rich value at that point of time. So we decided to turn down the opportunity to buy. So it is not normal for a company to say no to money. So we said no to money, and so then we decided, well, if we can't be buyers, why aren't we being sellers in this market? So we put our portfolio for sale in December of 2006, and we eventually sold. In 2007, we sold our portfolio of hotels to Goldman Sachs in 2007. So we came into the recession sitting on a lot of cash. Unlike a lot of the companies in the United States, we sat on a lot of cash. I joined the company in 2008, and when I was looking at, I was in a public company, and I don't know, I know a couple of you are in listed companies here. But a public company in the United States today is not a good environment for a CFO to be in, because there's enormous amount of regulatory pressure on everything you do. You're not really spending time building the business. You're really spending time, complying with the SEC. So I had already told my the board of directors of the previous company that I was leaving, and I decided to, either take a break or do something different. And then our boys, both my boys, I have two boys, they were in high school at that time, and my wife decided that we are not moving anywhere from Dallas, because you don't want the children's education to get disrupted at that time. So we stayed in Dallas, and I met Dr. Singhani and Patrick Barber. We talked for about 6 months before I came on board. So in 2008 of January, welcome sir, take a seat. In 2008 of January, when we decided to invest in apartments. So apartments is what we call flats in India. We built apartments. The reason apartment became a big business in the United States was a couple of huge trends occurred in the apartment business. One was when the recession hit, all the banks which were lending to anybody to buy a home stopped lending altogether. So there was a huge number of people who couldn't borrow to buy a home, and the only place they could do was to rent an apartment. And the other factor, that a lot of people lost homes during the recession due to foreclosure, etc. And at that time, they had to have some place to stay, and they came into the apartment business. And the other thing which was happening in India, we don't consider it as abnormal, but in the US it is abnormal. Children were graduating from college and coming back home to stay with their parents. And the parents were signing the lease so to keep the children out of the house so they could go and stay on their own, because they didn't want the children to come back to the house. So all these demographic trends contributed to a huge demand for apartments. So we started investing in apartments. In 2008, we built over 9 particular properties. Just go to the next slide. And this slide is very important. And the reason it's important is because it shows you how, it's a pictorial presentation of the earlier slide. And this red bar here that you see, it is the NAICRIF index. The NAICRIF index is the proxy for the real estate, like the Dow Jones or the BSE index, for example. That's a NAICRIF index is what we measure real estate returns by. And this is what happened to real estate starting from 1999 all the way to 2015. And basically the red line shows the return, meaning that it went up 30% and went down 30% depending on which particular year you look at. And the reason this chart is important is because it shows what ENCORE did during the same period. And what ENCORE did in the same period, when everybody else was buying, we were holding or selling. And when everybody else is selling, we were buying. It's because we fundamentally think our core research and our discipline allows us to make good decisions all the time. It's a very important picture of what we do as a company. And this next slide talks about a little bit about the evolution of our organization. We started with retail, hotels, multifamily, office, and land. This is how we make money. This is our operating cash flow. We medical centers, we operate dental clinics and freestanding emergency care centers. This is a new division for us. And restaurants, we have about 10 restaurants right now. We hope to be at about 55 restaurants in 3 years. And this is how we raise money. So we put money in every single deal, ENCORE does, And then we also raise money from 3 different sources: high net worth individuals, EB5, which is what we came here to talk about, and then institutional, which is pension funds and large money managers, from different parts of the U.S. And this is a common platform. So I equate this to, how many of you own an iPhone? All right. So I call this particular model, I call the Apple's iPhone's iOS model. This is the operating software. I can plug as many apps I can into this particular company and still make it grow. So Office is an app. I'm deliberately trying to use a common language. So we can add an app. I can add another organization here, but incrementally I'm not going to increase the cost of my organization when I do that. This shows because the foundation here is so strong. In fact, part of the reason our foundation is so strong is because we use a couple of our partners in Chennai. One of them is Mr. Panaya, and Srini is here, and then my colleague Suresh is, works with us in Hyderabad. So because foundationally we are very, very strong in this area. Go to the next slide. Again, now we talk about people. So I'll just let this kind of go through because we are so proud of the team that we are part of, and I'm also one of the partners of the company. This is the board of directors: Dr. Singhani, Mr. Barber, myself, and Charles Omaj. We are also the board of the directors. Can you flip back one slide? And the other fact, which is very important for us, each one of this has its own president. Every division has their own president, and the way they're compensated, they get, they have the third, a third. So a third of the compensation depends on the performance, a third of the compensation depending on the division performance, and a third of the compensation depending on ENCORE's performance. And what that does, everybody is aligned at the same time. So everybody is working together to make ENCORE profitable. And all of us, every president here on the board, we sit on an investment committee which meets every Friday. So every Friday, starting at 8 o'clock in the morning, we look at deals coming in. And all of us have the right to vote. Now, if everybody does not have a unanimous consent, we do not approve a deal. Everyone has to agree to making a deal. And what that does, it allows us to make sure that only the best deals come through the company. So another cultural value of the organization, something with a combination of the Indian ethic that we are so much a part of, and also the cultural attribute of making sure that we're making the right decisions all the time. And these are all, each person here has multiple years of experience. Glenn Peterson was in Marriott, and Brad Miller was a partner with Lincoln Property. Nick Barber started with the organization. Mark Seifert was with Aetna. Collectively, these guys have not only the 900 years of experience, but we have done close to about $10 billion in deals. So no dearth of experience in our organization. Keep going. So you can't hear me? No. Can anyone hear me? All right. So I don't think I'm good. Yeah. Because sometimes I talk away and then the voice gets low. So ENCORE research, can you just go to the next slide? Can you go to the next one? So this is where we think, go to one more one. Here, no, one, go back. Back up. Back. Back. This is, no, okay, so this is where we think the real estate market is in the United States. And this we look at this in 4 different quadrants. And the way we look at it, we use a clock as an example of how we invest in real estate. The clock meaning that at 15 minutes past the hour, when there's a lot of oversupply, you don't want to be investing in the market. I see that, I was talking to Shekhar about this earlier today. And we think that a little bit of that in India particularly is happening in Bangalore. There's a lot of oversupply going on. This is the second quarter is recession, which is you don't really want to be buying any property during a recession. The third quarter is when we decide when we want to jump in. A lot of people ask me, so how do you know which quarter it is? How do you know when to buy or when to sell? And our thing is that is exactly what our research does. We know exactly what the market is doing, and we have the ability to get data from everybody else to decide what we want to do. So this is phase one is recovery, which is the third quarter, and ideally you want to sell the late fourth quarter, which is I would say 55 minutes to the hour is when you want to sell. Depending on which particular quadrant you are in, you can either buy or you build or you sell. And we are in all of these circles. We see, if you think, for example, apartment, we think we have 4 to 5 more years of buying opportunity. And if you think about hotels, I think this is a great opportunity for us to start buying. And here in this particular cycle, we'll start building. So depending on which particular sector you're in, you can make a decision about what you want to do. Go to the next one. So this I told you about a little bit of, and this is a quick synopsis on apartments and why we think apartments, we went into the apartment business. This is the new generation, the millennial generation, which is a 25 to 34 year age group, particularly in the US. And my children fall into the same bucket. They're a little bit younger than that. But they don't consider buying a home as being very important. They want to have the ability to move wherever they want to. And my oldest son, he graduated from the University of Chicago 2 years ago, and is working in New York City. And to him, opportunities, not like we did. I want to join a large company and get a job settled down, get married, but not me getting married. My mom used to keep telling me to get married. So all of those things which are important to us when we were growing up are very different for our children. Our children don't think like us. They're much smarter than we were at their age. And they are? Yeah. And they also have a different approach to life than we did. So they prefer to rent than to buy. So this is a little bit of the fundamentals which is driving the business. So go to the next one, sir. This is a very important point. And this shows U.S. home ownership. During the boom period before 2007, the home ownership had gone to about 70% in the US, whereas historically it is 64%. What happens when it drops from 69 or 70% to 64%? All of these people are going to rent. Now you're talking about a significant population that went from home ownership to renting, and therefore apartment business is doing so phenomenally well right now. Go to the next. So this is just a civilian labor force. This is what we call the millennial generation. The millennial generation in the US is almost as great as the baby boomer generation. In the US we call a baby boomer generation. Anyone born from 1946 to 1964 is a baby boomer. And then we have different, they have different labels. But the millennial generation is now in the prime population for the apartment business. Go next. This is just apartments, right? This is how we track. We can tell you. You give me a zip code in the U.S. I'll tell you what the income is on that zip code. I can tell you what the demand supply is. I can tell you what the retail market drivers are. I can tell you the traffic. I can give you every conceivable data point within a zip code. Keep going. So, as I said before, we are in every sector of real estate. We started with retail, then we moved into hotels, then we made into multifamily apartments, then we're in office, land. Each one of the sectors is a different strategy. So you can build or we buy, and every time we buy something, we put money into it. On average, if we buy a hotel, we put anywhere from $3 to $5 million in it, and we build. Our average project size is anywhere from 25 to 50 million, depending on which particular market it is in. And every deal that we do, ENCORE puts in the money. So meaning that we start assuming that we will fund the entire amount. So a traditional deal, let's assume it's a $30 million deal. The typical debt equity structure, the debt we can get a loan of about 60% on that property, which in this particular case will be 18 million. The other 12 million, we put it from our own balance sheet without expecting one penny to come from anybody. So we put a lot of we use the money and set it aside and say, that's the money that we are going to use for that particular project. And then, once a deal is structured, we show it to investors and let them come in. So where EB5 fits in, and I think I'll talk a little bit of the EB5 right now, but if you think about, I don't have a whiteboard, so if you kind of step back and think about your own house, for example, all of us put money down in a house, right? We have anywhere from 25, 30% down in a house. And then the balance we take a loan, and the loan we amortize over 25, 30 years, right? So real estate is also no different. The only difference is our dollar amounts are much larger, right? Because we buying, at any moment of time, my pipeline is $600 to $700 million of pipeline. So we think about it a little bit differently. So when I look at that much in pipeline, then I look at the equity that is needed for that amount. So we're looking at significant amounts of equity that we have to set aside for a particular project. So what we did a few years ago, when we first heard about EB5, we didn't know what EB5 was. So then we started researching it and said, EB5 is a program by the US government which allows foreign nationals to invest in the US and create jobs and get a permanent visa. You get a permanent visa in 2 years and you hold on to the green card for 5 years, you become a citizen. They have a quota for about 10,000 visas a year. So 3 visas a family, so approximately 3,300 families get the visas every year. 90% of the visas today go to Chinese nationals. In China, because of the Communist Party, there's a lot of fear about what is going to happen. They are leaving the money in the United States because it's the safest place to put money, because they know it is secure and nobody is going to take the money away from them. And therefore they're putting the money in the US. Then we started getting interest from India. A lot of people from India said, hey, this is a good opportunity. Would you open up to India? So that's when Shekhar came across a few months ago, and we kind of towards planning of this. A lot of time and planning has gone into, and give a lot of credit to Shekhar for taking the time to pull this together, because it requires a lot of thought. But when we decided, so there's every one of you, by the way, can invest directly in the US. You can go to an area, buy a store, create 10 jobs, or whatever, buy a business, create 10 jobs. But you have to be there running the business. You have to make sure that you're compliant with everything. The difference between direct investing and regional center, which is what we do, we are one of the largest regional center platforms in the US. The difference between a regional center and a direct investment is that in a regional center, you also get the benefit of indirect jobs. So what does an indirect job mean? So there's an economic calculation which says that for every direct job that you create, there's, depending on which particular sector you're in, you can create anywhere from 2 to 3 indirect jobs. So if you're putting the money, you'll have to create 10 jobs. As I'm doing it to the regional center, I may have to create only 5 direct jobs because of the economic calculation that comes with being part of a regional center. So what we decided was, we will create a geographical spread based on where we think the good markets are in the United States. And all the green stars are where we have a regional center today. And so we have developed that, we have it today, but we're only focusing on, a lot of regional centers do business for other people. We only do our own projects. We don't rent our centers for anybody else. So you go one more slide. So we talked a little bit about us, and I'll just skip through this. You one more slide. So this is again, some of you had a question before we started the session. This really started back in 1990. In fact, a lot of other countries have it. Canada has it. They changed the laws last year. In Canada, you could invest in a bond and get a green